Test 1, 2.
Welcome to the meeting of the Audit Subcommittee. We'll start with declarations of interest. None received. All right. Confirmation of minutes. We'll try to keep this to under 2 hours. Okay. Carried. Then the first active item is the City of Ottawa Consolidated Financial Statements, and I will turn that over to the Treasurer.
Thank you, Mr. Chair. We'll give you a brief presentation, or I should say Mona Monkman will give you a brief presentation on the financial statements. We do have the auditors from Ernst & Young here as well, so they'll come up after if you have questions that you need to direct to them as well. So I'll just pass it over to Mona.
Thank you, Mr. Chair. As we've done in prior years, I'm going to give a brief overview of the consolidated financial statement results for the year. These are the statements before you, and Ernst & Young will then follow me and give you a brief presentation on the results of their audit, and then we'll open it up to questions. So in terms of what we will speak today is the statements and the audit results. In terms of an overview of what is before you in these financial statements, they are consolidated statements for the city, so they include all of the local boards, the Ottawa Community Housing Corporation, as well as the Police Service Board results. And it would include Pineview and the campground. On the financial statement side, our cash balances on our balance sheet, which is our statement of financial position, our cash balances are up. Our reserve balances are maintained at levels similar to prior years. Debt servicing continues to be manageable and is not increasing significantly in comparison to our revenue sources. And our employment benefit plan liabilities and pension liabilities are increasing as we discussed last year, and I'll speak to that a bit more later. On the audit results side, it is a clean audit opinion. If once all the procedures are complete that Ernst & Young has to do up until the date that Council approves these statements, which will be June. And we have one audit difference that we've been discussing between the City and the auditors, and we'll discuss that later. In terms of these financial statements, I wanted to start again this year, as I do every year, in saying the financial statements that you have before you are different than the financial reports that you get at budget time. Financial reports are budgeting. We establish a tax rate, a water rate. It's on a cash basis. It's what do we need to raise this year in order to pay off our expenses. And the financial statements are done on an accrual basis in accordance with public sector accounting standards set by the Institute of Chartered Accountants. And there are some differences. And the financial statements have terms in them that you may only see this once a year. So there are terms that show on the financial statements, the statement of financial position, what is the financial position of the city and how is it measured? And there are two measures. One is called net debt and one is called accumulated surplus. And essentially, the net debt measure says, at the end of the day, if you tally up all the assets, cash, accounts receivable of the city, and you deduct all the liabilities, long-term debt, accounts payable, what is that difference? And that's called net debt. And it represents the amount of resources that we will potentially have to take from future generations. So it's the net deficit. So in our case, what it is our long-term debt balances, less all of the cash that we have in hand. So it's $1 billion. The accumulated surplus number shows what is the bottom line financial position for the city. It's in private sector terms, what's the equity? And in our case, it means what are those financial resources that we've accumulated as a city that will serve future generations. And that is the bigger number. It's the $10 billion numbers. And what it's saying is we have invested in infrastructure in the city. We have $10 million worth of historical cost value of assets. After taking into account all of our liabilities, we're still better off that we have a financial position that's positive, and it represents the assets that we have that will serve future generations. And it's after taking into account the debts that we will pay in future years using future years' taxation. The annual surplus is another term in the financial statements that is very different from the annual surplus that you see when we report at year end, as we did in March, to say, okay, here was the budget for the year, $2.7 billion. Where did we land? The year's cash budget position was almost break even. We had a surplus of $386,000, I believe. The surplus we talk about here is very different. So we'll go to the next page, and I'll show you all of these terms that I'm talking about. This is our balance sheet, our statement of municipal financial position. It's the only statement I'll put up here today. But it ties it all together. Our financial assets are our cash and investments. It's $2.2 billion, and they're up $400 million. And the rating agencies like to see municipalities have significant liquid assets, money in investments, which we have. And that's one of the reasons why our credit rating is so high. Our liabilities are almost $3.4 billion, an increase of $493 million over last year. Those liabilities include amounts, almost $600 million, that are called liabilities, but they represent cash that we hold today that we'll use in the future. It's committed for future expenses. Primarily development charges and gas tax money is included in that amount. So the net debt amount then is the difference between the assets and the liabilities. And as I said before, that's the amount that we will, over time, recover from future generations. It's only changed a small amount this year, $82 million, and primarily it's the change in the unfunded benefit plan and pension liabilities. Our non-financial assets are our fixed assets, all of our roads, sewer, waterworks, buildings, land, and that's almost $12 billion after taking into account depreciation. So our accumulated surplus is $11 million. The change in the accumulated surplus is $386 million, which has gone up. And what that number is the annual surplus that's shown on the other statement, the statement of operations. And what that number represents is the amount of money that we have drawn from our resources and from grant contributions this year that is available to repay debt and also to build new assets. So that amount is turned into assets. So in terms of the numbers and these more significant items that are changing, the first one I wanted to talk about was the debt position. On the statement of financial positions, you saw there was a change of about $400 million in debt. The long-term debt number has increased by $345 million net. So that's after the amount of debt that we issued, additional debt we issued in 2012, less the amount of debt that we retired. So the net change is $345 million. That represents about 10% of the value of the assets that you saw in that statement. And the assets on a depreciated basis are about $11 billion. At historical cost basis, to acquire them, they cost us almost $16 billion. So that represents assets of about $16,000 to $17,000 per capita, compared to a long-term debt per capita of $1,500. When we talked to you about debt last time in October of 2012, we were before you with, here's our debt picture, this is what our long-term debt picture looks like and will look like at the end of 2012, which was the same numbers, and this is where it's going. We were also before you talking about the long-term financial plan and the comprehensive asset management plan. And we told you at that time that this historical value assets per capita really if we were to replace those assets is more like $35,000 per capita. $35,000 per capita assets per capita on a replacement value basis. And at that same time, we looked at that long-term debt picture and we said, we need to find a way to fund those asset renewal plans. And the ways we were going to do it was to use the resources we have now to put more money towards capital by using existing tax revenues and not to increase our tax-supported debt load in the future in terms of servicing costs. So our principal and interest payments, we have guidelines that Council established. One of them is that we will not incur more than 7.5% of our own revenues to pay for debt principal and interest, for tax-supported and rate-supported debt principal and interest. So at the end of 2012, that number was 5.45%, so well below Council's target. And when we talked to you in October about our long-term debt picture, we told you that this number of tax-supported debt costs would remain below 6% in the next 10 years. It will remain flat because the strategy for the long-term plan does not see us increasing this. We also have a provincial measure, which is how much of your total debt, which includes tax-supported, rate-supported, debt that we fund from our gas tax revenues, debt that we fund from our development charge revenues, capital lease obligations, and mortgages. How much of all of that? How much does that cost against all of your revenues? And the provincial limit is 25%. And so on the 2012 financial statements, the amount would be 7.9%. We told you back in October that that amount is 7% and will continue to be in that range. Will go up in the end of the term 2020s, 22 area because of our long-term transit plans. We have more gas tax debt. It's calculated as 7.9% for this year. It's probably a 1 to 2 year anomaly, more than the 7%, and that's because it includes the fact that OCH refinanced debt, and it shows as a debt repayment $20 million. This is offset by revenues that they brought in and repaid a debt, but on the calculation side, it impacts this percentage. So, looking at our debt picture and our manageable debt load, the credit rating agencies do look at it every year. We have recently had reconfirmed credit ratings by both rating agencies. We're stable. Our credit ratings are not changing. Both Moody's and Standard & Poor's have reissued their opinions. And they have looked at our long-term debt picture. They've looked at our long-range plans that we've done in the last year and a half, and they've re-expressed the positive credit rating. And one of the things that Moody's mentioned, particularly in their rating, was that we have done a lot of work around looking at what's our long-term debt, what's our long-term plan, how much money do we need for infrastructure renewal, and how are we going to afford it. So the use of the debt proceeds, in this year we issued, as I said, the net debt's changed $345 million, but we actually issued $467 million we received in debt proceeds. And where did that money go? Primarily, if you look at the first two lines, we use our debt to build roads, bridges, water, and wastewater infrastructure. We can't issue debt to pay for operating expenses. And so all of that money is being used in accordance with our long-term plans that we've put forward to you before. So we've also, and you may recall back in October, we gave you a comparison of where does our debt compare to other similar large municipalities across Canada. And back then the numbers were based on 2010 numbers, which were the most recent. We've updated the chart. This is a chart that's prepared by DBRS Credit Rating Agency. We don't have a DBRS credit rating, so we have prepared our own numbers using their methodology to show how we compare. And if you look at net debt per capita, and these are 2011 numbers, it's the most recent information. On the net debt per capita, we're comparable to Calgary and Edmonton, but we are the third, how would I say that? We're the third lowest. On the total debt per capita, we are the lowest. So our debt levels on a per capita basis are very comparable, and our debt servicing, the amount of money we need to take from our own revenues on an annual basis, which is 5.5%, is very manageable and low. The other liability, significant liability that is on our statement of financial position is the liability for benefit plans and pension plan costs. And these did increase last year more than the rate of inflation, and they are increasing this year as well. And part of that is because we're in a low interest rate environment, and these liabilities, they represent what are the future payments we're going to have to make for these plans under benefits that have been earned to date. They're discounted using, there's an assumption about what are we going to earn in future income in order to offset these costs. And when you're in a low interest rate environment, the calculations increases liabilities. But having said that, there is, we do have plans to manage these particular liabilities, and the Long Range Planning Committee looked at it back in 2007. There were strategies put in place to to limit the accumulation and the increase in these liabilities. And the first thing I'd point out is on the vacation leave liability, there has been no change in the unfunded position, so the plan put in place has been working. We have, the last line is, we have 2 legacy pension plans, and we are putting money from our annual budgets to fund these legacy pension plans. So we do have plans to fund those. The post-retirement and post-employment benefits are being funded as expenses are incurred, and the Workplace Safety and Insurance Board expenditures are increasing over the last 2 years because the liabilities are increasing as the type of benefits that are given out are expanding. So we will be coming back to committee and council later this year with a full discussion paper on strategies around these liabilities. And finally, I talked about our capital assets earlier, and that is a significant funding requirement for the city as we age. This shows the relative share of what are those assets that we have. And you can see that primarily our assets are those infrastructure road assets, infrastructure, linear, water and wastewater, the sewer and water pipes. And lastly, I wanted to just briefly, before we bring on Ernst & Young, discuss that we have gone through the audit. It's almost complete. During the course of an audit, there are items that we discuss and that the auditors may bring to our attention and say, perhaps you should account for it this way. We have discussions. There were items that we adjusted this year subsequent to those discussions, and there remains one item that we have not adjusted, and that's the commencement of the amortization of the capital assets. So our assets have to be written off over time as they're used. And in accounting terminology, that's the amortization of capital assets. And we're allowed to, under accounting rules, set the rules, the formula on how we're going to do that. And when we started accounting for these assets in 2009, we determined that when we bring on a road during the year, we'll start writing that off over time the following year. And Ernst & Young has asked us to review whether it's time for us to change that methodology. We didn't adjust for it in these statements this year, but it is something that we will be looking at. We agree that there's a need to look at it. It would require some more research and probably some systems programming changes, because we spent some funds to set up this computer system 3 years ago. So with that, I will leave it up to the auditors.
That was the introduction. Turn the mic on, please.
Mr. Chair, we have with us today from Ernst & Young, the city's auditors, Susie Gignac and Andre Charbonneau, who will give you their results of their audit for the year.
Thank you, Mr. Chair. I would like to just go through the presentation that we provided with respect to our audit results. We also provided a more detailed package, which we're happy to answer any questions on as well. We are, as Mona mentioned, nearing the end of our audit. We've had very good support from city personnel and anticipate that we will continue to do so as we finish up the audit. And we do welcome any questions from you as we go through our presentation. So we'll just walk through the services we perform, the results of our audit, a little bit around the strategy that we use to do the audit, and then the areas where we put the focus during our audit. So we're engaged to express an opinion on the consolidated financial statements of the city for the year ended December 31, 2012. And we also express opinions on financial statements for a number of other entities and programs of the city. We will issue written communication around items such as a management letter if we feel there are internal control issues that we want to bring to management's attention. We issue an independence letter, which you would find in the package that we provided, and if necessary, we'll issue consent to use our auditor's report in any documentation that the city has to file. In our status update, you'll see that we do have some procedures that are still outstanding, and again, as Mona mentioned, these continue on until council actually approves the financial statements, at which point we will get a letter of representation from management where we will ask management to represent that we have received all relevant information, the financial statements have been done in accordance with the required standards, and that we're aware of any fraud or other items that they would happen to be aware of. We will, up until that date, also perform additional procedures around legal letters and subsequent events that may have occurred that would require disclosure in the financial statements. And under other services, you'll also see that we do perform translation of the consolidated financial statements, which is in progress and will be done in time for the council meeting. For our audit strategy, we did follow the strategy that we originally thought that we would follow. We looked at entity-level controls, which helps us identify where there would be risks, and we concluded that those entity-level controls were effective for the December 31 audit. Based on that information, we look at the financial statements and significant accounts within the financial statements where there could be risk or potential for material misstatement. And from there, we decide whether our strategy will be controls-based or substantive-based. So controls-based would be that we are going to rely on controls of the city as part of our audit strategy. And we did rely in areas of purchases, payables, and payments, and also in the area of IT general controls around the SAP system. And where we don't rely on controls, and even where we do, we then also do substantive procedures where we look at specific transactions within the statements or the accounts, and also estimates that were performed by management. Following on for our strategy, we determined a materiality, which is essentially the magnitude of a misstatement or an omission that we feel could change the decision of a user of the financial statements or have an influence on their economic decisions. The materiality level that was set is based on standards and was $36 million for the current year, set at 1.25% of expenditures. However, our testing threshold for the work that we do is significantly below that, and we do, in instances, actually test specific individual transactions. Our strategy also involved engaging specialists to help us with some of the estimates that are performed by management in the statements. Management does have an external expert who provides support on the closure and post-closure liabilities related to the landfills and on retirement and post-employment benefits and pension agreements. So our areas of focus, tangible capital assets, which make up almost $12 billion of the non-financial assets on the city's financial statements, is an area where we focus. We look at the additions, the disposals, and the amortization, and we did identify an audit difference, again, as Mona mentioned, related to the amortization period for capital assets. In the current year's statement of operations, the difference would be approximately $5.2 million. In the statement of financial position, it would be slightly higher because there is an impact related to prior year differences as well. The revenue recognition, we performed substantive procedures over taxation and grant revenue, and we did not identify any significant audit differences in this area. Other areas where we put emphasis, we look at the completeness of the contingent liabilities. We get legal confirmations, and we also review contracts to make sure that liabilities are appropriately recorded and disclosed. We look at the disclosure of commitments, so again, looking at contracts such as the LRT contract, operating leases, and other legal issues to make sure commitments are appropriately disclosed. We look at the valuation of investments and financial instruments to ensure that if there is any write-down necessary, that's appropriately recorded in the financial statements and that the market value as disclosed is appropriate. For the employee benefit costs, again, we do look to the city's specialist and expert on their reports related to the employee benefits. We also do have an internal expert that we employ who reviews the city's external experts' report. And then evaluation of the landfill closure and post-closure. We look at the assumptions and the calculations performed to support that it is reasonably stated. So with that, there were some other differences noted in your package, which we're happy to discuss. And if there are any questions, we're happy to answer them.
Thank you. Okay. Our first question is from the Vice Chair.
Thank you, Mr. Chair. First, let me congratulate Mr. Kirkpatrick and the Treasurer on receiving such a good audit. It's always nice to hear that we're doing things right. So appreciate your work on that. I just have a couple of questions related to Mona's presentation, if I may. The consolidated statement of operations, it shows a significant drop in government grants. Do we know what that's related to?
The government grants is tied to, it's primarily capital grants, funding for capital projects. So it would have been higher last year and the year before because we had stimulus projects on the go.
So
and we had funding
associated
with that. So that would be the change.
Okay. And my other question was related to, on the same part, but under the expenses, the significant drop in planning and development expenses. Would that be the same related to the stimulus spending? It shows a drop of from 110 to 60.
Yeah, sorry. Last year there was a sale of some lands where there was a write-off associated with that sale, and that's a transaction that occurred last year, and that's not repeated this year, which is why there's a difference.
Okay. Okay, thank you very much.
Councillor Eglar.
With Mona's presentation, primarily I believe, but perhaps Ernst & Young can jump in and provide some background as well. You talked about debt, I think, at a ratio of about 5.4%. And I guess I have a number of questions that arise from that. The first one being, how does that compare to similar cities? By similar, I mean similar in size, either in Canada or the States, in terms of the debt ratio.
We don't actually calculate that particular ratio. That's against our 7.5% target that Council has established.
Correct.
The 5.45. We don't actually do that for other municipalities. The only thing we have is where we do it on a per capita basis. So, assuming that they're the same size as us, as Calgary and Edmonton are, their debt would be very similar to ours, very close to ours in terms of debt servicing. Now, it's the type of debt you have and the age of it as well makes a big difference, because our debt could all be very new debt at very low rates. Theirs could be older debt at higher rates. So it's a very difficult thing to calculate. The only municipality that we're aware of that has set the same type of cap that the City of Ottawa has is Toronto. And our 7.5 cap, Toronto set theirs at 15. And they bumped into that 15% a year ago and had to actually use a significant amount of cash to pay for a number of projects to bring that debt down. So there are not too many municipalities that have another limit beyond what the province has established for them.
Okay, that's helpful. You've talked to us about how much debt we're accumulating and what you foresee over the next number of years in terms of, the debt percentage that we're going to be carrying. What I'd like to hear is, do you have numbers today about how much debt we're retiring every year on average?
It's roughly $90 million a year.
Sorry, how much?
$90 million a year. It was a little bit higher in 2012, but on an average, that's what we retire on in a yearly basis.
We reissue into that.
Sorry?
We reissue into that.
Okay.
But we reissue.
That's correct. You have a policy where it's called revolving debt, so when it drops off, we reissue it. Now, we've had the benefit that what's been dropping off is dropping off at 7 or 8%, and we're replacing it with that's in the 3 to 4% range. So you're actually able to do more debt with the same amount of debt servicing as you had in the past.
Okay, and just to wrap up the two questions into one last one, so the 5.4 that you've been talking about and also the 90 million that we're on average retiring every year, how does that compare to, for example, to last term of council, the previous 4 years of government? Are we doing as well? Are we doing better? Are we doing worse?
You are probably doing about the same, because you remember, there's two parts to that equation: how much debt servicing you have and what your revenues are. Your revenue base has been growing quite significantly. So as a result, every time you take on more debt and you have more debt servicing, the ratio actually stays the same because your base is growing as well. So if I were to look at this historically, I think when we started amalgamation, we were probably at about 4.5, 4 3/4, and we're at about 5 and 5.45. But the amount of the actual dollar value of the debt has tripled in that time period, because that was all debt at that time period that was at 10 and 12%. So the debt servicing has remained more or less constant. It's
Okay.
increased a little bit, but your base has grown. So as a percentage, it would be almost flat.
Okay, thank you.
Councillor Wilkinson?
Thank you, Mr. Chair. On slide 6, Mona, of yours, when you're talking about the liabilities and debt, so sort of following on that, I know we have the 7.5% cap of general debt, and then we have legacy debt on top of that. Now, have we we're getting into the legacy debt, because that's what we're going to do, things like Lansdowne and things. So how do those two compare?
The 7.5 actually includes your legacy debt as well. The legacy debt issue was one where you were looking at what would be the impact in any 1 year on the tax bill. And you said that you did not want any more than 0.5% of the impact of a change in the tax bill from year to year to be as a result of debt, except for legacy debt. But legacy debt is still included in the overall number. So it's still, all the legacy debt we've issued so far is in that 5.45%, and it's still capped at 7.5%.
So I know the legacy debt with Lansdowne Park is the legacy debt if it's been issued yet.
Lansdowne has not been issued, but we have issued legacy debt for the for the convention center. That was one.
Yeah.
Also for the archives building, that was another one that you approved legacy debt for. There were a couple of other smaller projects, and when we do the debt issuance for the new transitway, again, that will be termed legacy debt because it'll have a bigger impact in the year than.
So when you issue that Lansdowne debt, which is over $100 million, I believe, then that 5.45% of own revenue will obviously go up at that point then.
It may not, because, again, your base is growing. The amount of revenues that you are collecting as a city is also growing at the same time. Okay. So don't forget that part of the argument that was put forward with Lansdowne is that you are expecting to have increased taxation as a result of the new properties coming online there.
That's mythical.
So that's part of the revenues. The taxes coming in are the revenues. So the debt comes on, the debt servicing, but so do the revenues at the same time.
We were told with the convention center that we'd be getting revenues from new hotels and things to help pay that legacy debt, and we haven't seen any of that yet. It may come, but hopefully it'll work out. I'm always a little bit iffy about tying debt. Anyway, the other one you have here is city and OCH mortgages is 7.9%. So what's the difference between those? Is that not included in the 5.45? So this is a different one only on mortgages. And what are the city, I know what the OCH mortgages are, and we've refinanced them to create more money for maintenance, but what are the city ones?
There are no city mortgages. There's only Ottawa Community Housing Corporation mortgages. That's their line on the financial statements, but also included in that number would be all the debt that we have issued that is funded by gas tax, by development charges, and also included in there are capital leases, which in the accounting world, capital leases are considered just another way of financing capital acquisitions, so that's included in the debt number as well. And that's the province's formula. We use the way the province calculates this to come up to the 7.9. It's their document.
So we don't have the breakdown of which is which in here. I guess you do in the detailed reports, but not here.
We do in the financial information return. If you actually go to Schedule 81, Schedule 81 of 100 different wonderful financial schedules is actually the calculation for the City of Ottawa for our debt servicing limit. They actually have us prepare it, and then they vet it, and it shows all of the breakdown of all of the different types of debt that's included and the sources of revenue that they use as the denominator.
So when you do the development charge one, do you do it by category for like roads and parks? Because there's different categories, or is it just debt services in total?
It's just debt servicing in total, and then we extract the debt servicing, that's development charges and gas tax, to come up to that 5.45. So we start with the total, and then we extract the ones that are not to be used in the formula that you have given us for the cap of 7.5%.
Okay. I know just that what you're working with, the big projects we have underway now, because they're pretty enormous, with all the funding that you've given us before, should not have a major impact on this level from what I recall. Is that correct?
That is correct. I think that's what Ms. Monkman was saying, is that it's going to be flat until about 2020, and then we see, as a result of, at that point in time, it's the LRT is coming on stream. We'll be taking over that $300 million in debt. That's the equity portion of what the private sector is providing in the deal. That'll become our debt, and that'll push us up at that point. But other than that, it's generally flat.
And have you actually calculated in all the other projects they're going to be doing in the next 5 or 6 years? Because the LRT isn't everything they're going to do.
We've actually done it actually out till 2042 in the transit world, and we've done it out till 2022 for both water and sewer and for the rest of the tax supported. That's our long-range financial plan, is looking at what are you planning on doing and how are we going to fund it and what's the debt that's required, and we put that all together for you when we brought the long-range financial plan in October, which gave you a complete forecast of what we see the debt being over the next 10 to 20 years.
Based on reasonable interest rates?
We actually, because we're accountants, we use very conservative, so the interest rates we used in those were actually higher than we're actually able to get from the market these days.
Thank you.
Thank you. To the auditors, and this is going to sound a little bit like deja vu, on materiality, last year when I raised the question, and I think we're at 27.9 million last year under materiality, and which I thought was high, and it's the materiality level you're using for this year is 36 million, which seems extremely high, and you've gone from 1% to 1.25%. I know you're talking about the actual tested value is a lot lower. Can you rationalize that again? I know you did last year, and I probably come back every year and ask the same question. So I'm just giving you a heads up for next year, too.
Yeah, the standards actually, the CICA handbook and the auditing standards provide a range which is considered a reasonable range for your materiality. And when you're doing it based on expenditures, you can go up to 2%. So we are still very conservative in using 1.25%. And we did look at the risks, and the result was that we felt that 1.25 or 36 million was reasonable, and we do, as you mentioned, do things at much lower thresholds than that. So we really take this to determine the differences on our summary of adjusted differences, or unadjusted differences, what would consider in total or in aggregate to be material to the financial statements overall. And based on the audit, the only item currently that affects the statement of operations is the 5.2 million difference related to amortization, so it's really much smaller than the materiality level or threshold that we used for the audit.
But you don't feel that that level is way too high, that in terms of, if you're looking at risk, that we should be looking at something far significantly lower?
From a materiality perspective, I think we feel quite comfortable that it's within the range, and it's a reasonable materiality from an audit perspective. We provide an opinion on whether they're reasonably stated in all material respects, and from that perspective and an audit perspective, it's quite reasonable.
Okay, thank you.
Thank you. Okay, I have a couple questions, and the first is to the treasurer. 5 years ago, we introduced the floor and ceilings for our debt. We didn't introduce them; we reintroduced them. And you had a rationale at that time for establishing a hard number on reserve floor and on debt ceiling. But on reserve floor, how has the thinking changed on that to bring us to where we are today?
With respect to reserve floor, we introduced, with the long-range financial plan, we actually set new targets in the water and sewer area, and that was because those two areas, which are infrastructure intense, require more capital monies every year than we can basically raise through increasing the water rates, even though they're increasing at 7% this year and 7% next year. In order to raise the monies that we need to invest in the water and sewer infrastructure, it would have to be significantly higher. So Council adopted a strategy of actually using more debt in that particular area. And in order to ensure that we were not going to be impacted from that, from both a credit rating perspective and also from a risk management perspective, Council agreed that we would increase the value of those reserves to the point that we were carrying the equivalent of 1 year's debt servicing in those reserves. That's a long-term strategy, though. You can't get there overnight. So the approach we took with it was that over the 10-year period was when we would get those reserves to that particular balance. So that's really the only change that we've had with respect to the floor that was established. We do not have one for the transit reserve, and we do not have one for the citywide capital reserve either. But again, we're looking to make certain that you at least keep the $200 million in the endowment fund as your fallback should you need it for any other purpose. But Council reconfirmed as part of the long-range financial plan that that particular reserve would stay unused or undrawn down, and we would continue to earn interest on it and take that interest into our accounts for use for capital purposes.
All right. The second question relates to the retirement of debt that Councillor Egley talked about, and how that fits into the change in our net debt. Total net debt. If you could just speak about that a bit.
Certainly. Every year, because council has approved as a strategy that we would have revolving debt, that we would keep the debt servicing the same in the budget, and when the debt retired, we would just reissue it to advance more capital works. And in 2012, I believe we issued just over 400 million in debt, but we had retirements of approximately 100 million, so the net debt increase was 300 million. So every year we go out and we issue, but we have retirements that offset that, so you never see the full amount of the issue being added on to the financial statements. It's always offset by the reduction in the retirement of debt within that year.
All right. And in the upcoming years, we have a couple of major issues that you've discussed earlier, light rail. We have the initial part of Lansdowne. How are they going to be captured within that ceiling?
The Lansdowne debt, we are planning on issuing that in the second half of this year. So that will fit. It will not make a difference with respect to the debt servicing as a percentage, because as I explained to Councillor Wilkinson, the amount of revenue that you're going to receive is also increasing. So your numerator's going up, but so is your denominator, and they're going up basically at the same rate. So I don't see any material difference in the 5.45 going into 2013. Maybe it goes up.
So the denominator will come on stream at the same time?
That is the plan, is that that we'll get. Actually, the debt servicing will start in 2014. If we issue it this year, you actually won't see it until the 2014 budget, because it's the first debt servicing is 6 months after you issue. The debt will show actually in the 2013 statements, but you will have increased revenues in 2013 as well. So as long as those two go up at sort of this at a steady pace, it doesn't make a material difference. The light rail debt, though, doesn't come on stream until 2019. So that's still a ways off, and again, that one will make a difference, because that's a significant piece of debt that the city will then take responsibility for, the 300 million that the private sector firm is contributing as their equity into the project.
So that likely will be a 300 million difference, right?
There will be a bump up of 300 million in that particular year, yes.
Okay. All right. Thank you. My next question is for the external auditors. And just if you could describe for us the differences you have with management, and how, from your perspective, those are being handled.
We had discussions with management around some methods of accounting for certain transactions. We had we were able to come to agreement on the accounting, and/or management, as they mentioned, has agreed to look into them in future years in order to determine what changes have to be made to systems. Other than that, I don't believe we had any discussions that I would consider disagreements in any way.
Okay, so ultimately there aren't any disagreements on how we're moving forward. Is that what you're saying?
No, I mean, management either corrected where we had differences noted in our audit work, and/or we've had discussions around the capital asset amortization and the changes that I think they're going to look into whether they will make it in the future.
All right. Okay. Deputy Mayor DeRoche.
Thank you, Chair. Sorry, just you brought up a couple points that prompted me to ask a question. So, Treasurer, just on the reserve, so on page, I guess it's one of the annexes there. Can you explain to me why it's in the note 12? So So it has the endowment fund listed, it has all the reserves. What's the criteria that we would use to be satisfied with the housing reserve? Because OCH has a reserve, we have a reserve, we've got a long list of things that need to be addressed from a housing perspective. Would council reach a point where we'd say, you know what, that's enough in the reserve in terms of a contingency, let's put some of it to work because it makes sense in terms of upgrading things now and dealing with the liabilities now as opposed to later. I just sort of wonder if we've really kind of thought around the housing reserve specifically from a strategic point of view.
The housing reserve doesn't have a ceiling on it, or does it have a floor? It's just a repository for surpluses from the housing branch at the end of every year, and also you have your housing first policy, where when we sell land and a portion of it, that's where it goes. So, and also when because the province gives us money to deal with various housing issues, that will be the repository for it. From a strategic perspective, there are rules around what you are to use it for, but I don't honestly think it's been considered in light of what OCHC, what their requirements are as well. They do have a fair amount of reserves as well, so it's not as if the city is the only one sitting there with the housing reserve. OCHC has good reserve balances as well. But I guess the conclusion I would come to is that the city reserve is not only just for OCHC; it's for all social housing providers, and it's used as that. It's our seed money for when we get. We have to put 1/3 funding. So we have not relooked at that reserve and its uses. It's more or less been it's been a constant value in there. Money's come in and gone out, but it's more or less stays the same every year.
So when would be a juncture where we, as a council, would maybe look at that one and say, you know what, the limit is 40 million, and anything above that we're going to invest in the capital needs, which are long and
there's only 7 million in our reserve right now. So most of that is OCHC. Okay, they have 42 million. So the city portion, like I said, is not big in comparison to what they have. But I would think if you wanted to look at the issue, the continuance of a city housing reserve and what it's used for, most likely an appropriate time would be when the long-range financial plan comes forward from Ottawa Community Housing Corporation.
Yeah. Okay. Thank you. Thank you, Chair.
Thank you. Any more questions? Comments from staff? Okay. No. All right. So on the item, is it carried? Carried. So thank you very much. This was entertaining and riveting, especially for the media who stayed. The Vice Chair says that's because it's a good news story. Anyway, thank you very much, and good job. Thanks. The next item, because it just keeps getting more exciting, are the sinking funds. And we'll turn that over to the Treasurer.
Mr. Chair, this is just a report we have to provide as a result of rules within the Municipal Act. So sinking funds are just a type of debt that we have where you actually make a contribution every year towards a bank account, basically, because the principal doesn't get paid off every year. It gets paid off in balloon installments. So if you have a 20-year sinking fund, you may pay off half of it in year 10 and the rest of it in year 20. And so we put money aside every year. We earn interest on that money because we invest it. At times when we close it out, when we actually make the payment to the bondholders, there's little bits of surplus left. This report prepares the financial statements, also identifies that there is a little bit of surplus from a sinking fund that was retired in 2012 of $1.3 million, and as per your policy, we will contribute that to the purchase of environmentally sensitive lands reserve. And that's the Coles notes on the sinking fund report.
Questions? Vice Chair?
I'd say if I could just make a comment, it's going to be rare, but I'm going to disagree with the chair. I think you actually make numbers sound good, and I appreciate the report. And so the sinking fund, there's a big difference here in your report. It's dropped quite a bit. Can you just allude to that?
It's dropped because we've made, one of the bonds has retired and we've made the payment. So that's why it drops. When we actually go out and issue this type of debt, we pass a bylaw that says you have to earn, given that you're going to pay that over the next 20 years, you have to earn 3.5% or 5% on that fund every year in order to be able to make those interest and that big principal payment in the year that it's required. The auditors come in and they look at what we've earned. They've looked at what's been expensed, make calculations about all kinds of things, and come to a conclusion about whether, in fact, we're solvent. We basically can afford to make these payments in the future, and that's the reason. But the only reason why it shows a drop is because one bond has retired and we've paid it off. And I think it was a $50 million bond in 2011 or 12 that dropped off the books.
Thank you very much.
So on the item, is it carried? It's carried. And so thank you very much. We now have the final item is the status update and the recommendations 2 and 4 of the Auditor General's report relating to the management of vacant positions. So we have questions. So could the Auditor General and Deputy Auditor General come forward, please? Thanks. We actually require a 2/3 vote to have this on the agenda, so can we move to do that? It's
well,
there.
I would hope there's a 2/3. It's on the agenda.
Yes.
There's a question audit. We have the Auditor General here, and we have the City General
so is that carried?
City Manager here.
It's carried?
Carried.
Okay.
I think we're going to have to look at the procedural things one of these days. Mr. Chair, just a quick question on recommendations 2 and 4. When these observations were raised in the audit, they seem to have a certain significance to them. When I read the recommendations now, the resolution of the area of disagreement, it seems to have diminished importance. So I want to understand from the Auditor General, I know you had discussions with the City Manager and with HR staff in terms of how this can be accommodated. We've got two new we have responses to the two recommendations, recommendation 2 and 4. But what does that really change? I mean, if the concern is about vacant positions and vacant positions staying on the books, all I'm seeing here is there will be additional reporting at budget time that will tell us about these positions. Maybe we didn't know about them before. But if they're vacant and they're vacant for a long period of time, to me the importance of the question really becomes, should they still be there?
I think it's still a major issue, and what you're seeing, in my opinion, from management is still very significant in the sense that this information did not exist before. The term vacant position in my opinion, should not be used because they are used. What you will have at the next budget is more detailed information so you can decide if you want to proceed with that. Recommendation 2 address the issue of summer student, part-time, and so on. And there's roughly about 100 FTE attached to that, representing about $8 million. that's something you will be able to decide. You'll be able to ask questions to mostly Parks and Rec. We are using these vacant positions. I hate that term. They're not vacant.
But
there are
they're really seasonal there, I believe.
They are seasonal. They should be called like that. You should have that kind of information, and therefore you could challenge or ask question to management. Okay, you're telling us that you'll use 100 equivalent of FTEs for pool, for Parks and Rec. Is that okay? Too much? Too little? I don't know. The point is you will have that information. I strongly suggested to management that they start using other terms to call them. They're not vacant. They're used. The point is, for you, you don't know if, like I said, if you want to have that type of resources devoted to these positions because they're called vacant. And I know some of you try to reconcile these things, and it's almost impossible to do. So what I understand from the city manager, and we had a lot of discussion on that, is you will have that type of information at budget. You will be able to decide, okay, we want so many people at part-time or a seasonal or summer student and so on. So they will not be lumped into a group called vacant position. So that's for recommendation number 2. Number 4 is a little bit the same thing. You have over 600 positions, 684 positions when we did the audit in 2011, as of June of 2011, that were outside your approval process. They were not also part of the head count. So that also you will have. You will be able to ask questions. You will have more information about this position in specific area. So you'll be able to decide. Right now, you were not aware of this position.
Okay.
Now you will.
So let me just refer a question over to the city manager. I'm looking at the recommendation, for instance, recommendation number 4, and the response being that, that the two sides here have agreed that there'll be additional information on the FTEs, and it's a supplemental document as part of the draft operating budget, and it'll give us more specific detail as to how long incumbents occupy unbudgeted temporary positions. I guess what I was really looking for, and I don't think we're going to be in a position as council to say, I've got this report now and I'm going to arbitrarily cut half of those positions and realize the savings. Instead, what I would think is the departments would come forward and say, look, we've got these unbudgeted, well, no, they're unbudgeted at that point, but if we have temporary positions and they're included in the budget, we are in effect collecting taxes for budgeted positions that are vacant. What we're looking for is, how do we realize a savings by not carrying those that are more than 24 months or whatever it is. As councillors, we're not in a position to make that decision at that point. It's too late in the game. The department should be coming forward and saying, you know what, we can relinquish these positions. They're no longer necessary. They haven't been filled for X number of years or months or whatever. To me, that's the next step to this, the agreement that was reached. Would you see that happening, or? Because otherwise, the reason I'm saying that is because otherwise, arbitrarily, one of us will put a motion on the table saying, according to the supplementary report you're giving us, there's 100 positions here, cut half of them.
Right.
Without any rhyme or reason.
So as the Auditor General indicated, this was information that was not provided to Council in the past, and that is a significant improvement. Management agreed that is information that Council should have in front of it. To what extent are managers throughout the corporation using some of the funds that Council approved in a budget to fund full-time and part-time equivalents? To what extent are they using those funds to pay for other positions other than what Council approved during the budget? And the right time for Council to have that information is prior to approving another annual budget, was our agreement. We actually provided some of that information in the 2013 budget when we tabled it last year as a result of the recommendations that came out of the audit that was done in 2011. So what I would anticipate happening, Councillor, is that so this fall, when we're back in front of committees and Council with the tabled budget, that there would be questions that would be asked in those standing committees from those general managers and directors about the information that's on that schedule. So in addition to the, maybe Susan Jones, in addition to the number of FTEs that are in front of us with your proposed budget, we also noticed that last year, or as of September of 2013, you had so many unbudgeted temporary positions on, and and we see information about how many did you have at the beginning of, so in a year ago, how many do you have now? We see information about where are those positions, how are they funded? Are they funded from grants? Are they part of a capital project? Or are they being funded from gapping? And that's really the connection between the use of temporary unbudgeted positions and what council approves in the budget. Because of course, every manager in the city is responsible for running their programs within the budget, the dollars that council's approved in the budget for that. So this isn't an issue in terms of expenditure management. It's an issue about how managers are using the funds council's approved within their budget. So last year there weren't any questions, but this year I would expect there would be about, tell us why you have that many unbudgeted temporary positions that you've used over the last year, and when we hear your answer, that may have some bearing on what we approve in your budget.
And I recall you referring us to the document that said, here's where you see those, those vacant positions or unbudgeted positions, whatever, because you did provide us. But what I recall is that we did really nothing with it. And I think we were, and I don't want to quite admit this, but we were looking at that saying, okay, how do we use this as a tool? And I don't think we quite got our minds around it. And when you talk about the gapping, I mean, and I think at the federal government, they probably refer to it more as slippage. And you could see how certain departments will build that into their base budget. And so as we're sitting there, you can say, well, yeah, they're operating within their approved budget. But if they've already built in extra positions that are vacant, that haven't, and that are being, that money is going into, that is a potential savings. And that's what I think that's what I thought the AG was getting at originally. But this seems to have shifted somewhat. And
I think it is the subject matter that you, or the dynamic that you've just described is the issue at hand. In my opinion, how many unbudgeted positions did a general manager use throughout the year, and how are they funded? I think council would look at, of course, those were funded from provincial grants, no question. Those were connected to a capital project, that's fine. These ones that were funded from gapping, though, so we're approving so many FTEs and so many dollars in your budget to run your programs. Clearly, you're using some of that money for positions other than those that you put in front of us to approve as part of that budget. How can that be? Maybe your gapping target isn't high enough.
Okay.
I just would like to highlight that at the city, our policy, we put a budget in front of council that we recommend that includes for full-time positions, well, for all positions, full-time equivalents, the full dollar requirement, and then we challenge every manager with a gapping target. So we actually, there's the gross dollars required for those positions, but there's also a budget that's put in for gapping. It's about 3% on a corporate-wide basis. So we challenge managers. They don't, in fact, have the full envelope of funding available to them to run their programs, because we know that throughout the year there's vacancy, there's churn in the positions.
Well, it's turnover. Yeah, there are vacancies, turnover. So obviously the onus is on us to be more attentive to that information, because I think last year we didn't fully use it, or it got buried in with other things. So in something like that, if we're looking for positions that are either budgeted or unbudgeted, something like the baseball stadium that's sitting there dormant, will we find unbudgeted or budgeted positions attached to that are already being prepared for the following year? Is that where, things like Lansdowne, we had staff that were allocated to Lansdowne. As that role changes, are we going to find some of that in that supplementary report?
In terms of a broad answer, I'd say no, that I would certainly hope not. And frankly, part of this, again, we improve as a result of audit recommendations and how we consider them and how we respond. So this is an area where we weren't providing information to council and the public about the use of unbudgeted positions. Frankly, when the audit was done, there was over 1,000 unbudgeted temporary positions in the city's establishment control system as part of the payroll system. When we looked at it, we saw that almost 500 of them were actually vacant and hadn't been used in quite a period of time. But no one was going in and pulling those positions out of the system. They were just lying fallow, if you will. There was no budget associated with them, but they were still, there was noise in our management control system in terms of data on the establishment of the city. it was frankly my decision that we were, as part of the audit response to the audit recommendation, we were going to create the schedule and we were going to give it to council at budget time. That frankly created the motivation for general managers and management to go in there, strip out the positions out of that system that are vacant and not used anymore. An example might be, related to the baseball stadium and others. So the data that's in there is, in my opinion, now very clean, and general managers, because they know that they may need to, describe to you exactly why they have those positions and why they're using them. I would hope that you would find most of the answers defensible, that I would too. In terms of permanent positions that you've approved that aren't required, again, I've directed that I want all of, to the extent that exists, I want them taken out of the establishment so that each year when we put the budget in front of you, what we're asking for in terms of full-time equivalent positions is exactly what's needed for the programs that we're proposing to run. The dollars are associated with them. There's a targeted gapping target that manager is supposed to achieve. And then the last piece of that, for you to have a sense of what they're doing, is this issue of the unbudgeted temporary positions.
Okay, thank you.
Councillor Duresh.
Thank you, Mr. Mayor, Mr. Chair. Councillor Blow started out saying, we need to look at the process, and I agree with them, and I've said this before, that I think when we get these kind of situations, that this is in a sense a failure of our process, that you are saying one thing, Mr. Auditor General, the staff are saying one thing. I would like to think that the disagreements that come to this table are significant, are showstoppers of disagreements. And when I read this, I'm not seeing this as a showstopper where we couldn't find some common ground between what you're saying we need to do and what the staff are saying, here's the reality we're facing, and we don't think we can do it because we don't have the information on the federal funding. So do you view this as a disagreement that is of significance that needs to come to the table for this committee to be the referee? Because I think both sides raise good points, and I'm not sure how I'm supposed to decide this, but I do know a lot of staff time has gone into the back and forth between staff on this recommendation. So how important are these recommendations that we couldn't have reached some sort of agreement or common ground?
Mr. Chair, for recommendation number 4, unbudgeted, we were talking 684 position representing $58.4 million that you did not properly approve. I think it is significant that you should know that. They're not part of the head count. Nobody knew about these positions. So when we first put that to management and we have a process to deal with that, we were recommending that he provide you additional information on these positions so you could decide if they are needed or not. As you know, you've been asked to approve number of FTEs, operating budget, capital budget. This was not approved, that amount. The other amount for recommendation number 2.
You're talking recommendation 4.
4, that's what I was saying.
So their answer is, sometimes we don't know. These programs that we have from the federal provincial governments are so last minute, we don't know how much funding we're going to get. And I think if you found cases where they're hiding information from us or they're not being as forthright as they can, but it strikes me that if that's a valid reason that they just don't have that information to bring to us.
Federal programs are a minor part of these positions. Most of them are not tied to federal program. As the city manager was pointing out, is from gapping. So, and even from the federal program, management knows about them. They know them in advance. So they were not reporting that information to you as part of your decision process. That's for recommendation number 4. For recommendation number 2, first of all, there was a motion that you made that any true vacant position should have been reported to committee, and it was not. Okay, so that's against a policy of council. In my mind, it is important that I report that to you. The second aspect is you have 100 positions that they are calling vacant position, giving the impression that they are vacant and they are using the money somewhere else. when you approve this. It's not true. These positions are being used. They are being used by individuals. And our recommendation was to report them to council, and they're part of the approval process. We had about, I would say, 2 or 3 meetings with the city manager, with staff, trying to explain our point, trying to explain how important this issue was. And finally, the city manager decided that, okay, from now on, this is what we will do. This is what we will report. And this is why, at some point, we came to an agreement today. But I probably did, over the 9 years I've been here, over 1,000 recommendations. And I think we have disagreed with less than 1%. Mm-hmm. And when we're seeing these types of numbers in terms of financial, it's pretty. You would admit, Councillor, that $58 million is pretty important. That we need to discuss that. And yes, we did spend some time. I don't see it as a waste of time. I don't think the city managers see it as a waste of time, because during that process, what we did, we kind of understood what was going on, what was the process, and it was helpful for everybody. So today we can arrive to a solution that I believe are pretty significant, in the sense that we will provide you, the city will provide you additional information, and you will be in a better position to approve the budget when you in fall. Because before you didn't have that information.
But so then you agree. You're saying, you need to provide clear information, the best information you can, and staff are saying, we're going to do the best we can to provide the clarity and as much information as we can on the summer students program when they know it. Again, I'm not sure what the disagreement is here.
The disagreement was they were not reporting that information before. And that's what we're raising to your attention, and now they agree after that process. That was, in my opinion, a major disagreement. If we had agreed before we tabled the report in November, we would not be here today. But it took that time to understand the process, and it took that time to come up with a solution. That mechanism was planned in the audit subcommittee charter. So I think we're doing it's a pretty good record when we ended up having 2, when we have hundreds of recommendations per year. So if you're seeing this mechanism being a waste of time or a process, well, that's something you may discuss. But with the numbers we have here, I believe it should be in front of you.
Mr. Kirkpatrick, do you want to add anything to that? Since I guess I'm questioning both sides. When you have disagreements.
Okay, just before. Okay. I think the Auditor General made one of his best points on this about 2 months ago, when you indicated that what's the point of agonizing over getting the head count right if you're that far off on reporting to council how many positions there are that are unreported or had been previously unreported. So this is a reporting function. I think they've now narrowed the issues, and there has been a change, and more information is going to go to council. And I think that's what the Auditor General is trying to indicate is the sort of the win on this for taxpayers. But
and I guess my point is, it sounds like it was a long road that consumed a lot of resources to get us where we are today. So I guess my question is to Mr. Kirkpatrick. I mean, what should we do when we're in a situation where there's a disagreement over a recommendation, so that we can bring it to some timely conclusion that achieves the objectives of the Auditor General and satisfies the staff's concerns?
I think so first of all, just to reiterate, the Auditor General made recommendations and management responded, and as the Auditor General has indicated, the vast majority of the time, that by the time the Auditor General tables his report, we've reached an agreement on his recommendation. So that is a good news story, and it is an effective process. Occasionally, like in this case, we didn't reach an agreement. There was a difference of opinion, and it doesn't happen often, but when it does happen, I believe there's some good reasons on both sides for the opinions. And so, if we look at question number 4, the audit found that there were a significant number of unbudgeted positions the use of which council had no knowledge of, no information. That's a significant finding. The Auditor General recommended that we should be reporting those to council, and we should ask council to approve the use. That was the issue of the disagreement, was the issue of whether council should be approving the use of unbudgeted positions as management was using them. Management's position was temporary. The requirement for temporary positions comes and it goes. That if management is working within the dollars that council has approved in the budget, that is a reasonable authority to be delegated to council. And the Auditor General pointed out, well, perhaps, but if they're not actually temporary in nature, if they've existed for a significant period of time, that's important context in terms of whether that authority is reasonable or not. And that's why what we said is, well, we're going to focus on these. We're going to report on them. We're going to make sure that they truly are temporary positions, and these aren't positions that have been staffed for years at a time. We think that council, therefore, would accept that, yes, management has the authority to use temporary positions in that regard, but we should report them, and we should report them prior to the meaningful time to report them would be when council is making decisions about the next year's budget and how many dollars and resources they're going to allocate for the operation of programs. I think in the end, you've got a very effective audit management engagement process here. The criticism, which I would hope to be is constructive, is, I mean, perhaps you could be saying those two recommendations that you did not reach an agreement on, that you've now reached in both cases, I think, in a middle ground where the auditors, agreed to something slightly different than what he recommended, and management's agreed to at something different than the position it was holding at the time the audit was tabled. Could you not have reached those middle grounds perhaps prior to tabling the audit? In most cases, we did. In these two, we didn't. I don't think a significant amount of time, other than perhaps the committee time here today, is being expended on it.
Okay.
Next year, it'll be no disagreements.
That's helpful, because I guess my point is when it comes out, when you go to print and there's disagreement, then there's a tension on that saying, wow, this must be something of significance here. What we're really saying is we disagree, but we need a little more time to either answer some of the questions that you're raising. But I'm pleased to hear that this one did not take the amount of time that I guess I was assuming.
I could just give you some painful perspective from the
Somewhat?
painful perspective from the last council when we had the COG, the Council Audit Working Group. I think I'm the only member of council that survived that. The rest have left the corporation. But we used to meet regularly with management and the AG and go over the most eye-drying recommendations and facts and figures you could ever imagine. And that happened after every single audit. We would advertise this to the media, but they never showed up, and because it just wasn't that exciting. But we actually had that, and when the audit subcommittee was reconstituted this time, I know it was the deputy clerk's wish that that function from COG would transfer to this committee. And so I don't think you're going to be able to avoid at least some of those each audit period, because the audit must come out by the pre-designated date, right? Is that what we're getting at?
I don't think so. We need some kind of mechanism to have. It's rare it happened. It did happen, because if you don't have that mechanism, of course, the office could make recommendation. The city manager could agree or disagree, and I cave in. And I say, oh, okay, sorry, I'll rewrite it, and I don't think this is what you want. I think at the end of the day, it's okay to agree to disagree. The number of instances is the issue here. When we have two issues and, like I said, hundreds of recommendations, I don't think it's a big deal. And I want to address Councillor Desroches' point when he says staff is saying it takes a lot of time. Like the city manager has mentioned, I don't think it takes that much time of staff. unless somebody else is talking to you except the city manager, because he will tell me if something is wrong, and never mentioned that to me. So that we were a burden, and we were taking too much time to resolve an issue. So it's very difficult for my office to gauge if we're taking too much time, if when my contact point for the city, which is a city manager, is not raising this issue. And he's not raising this issue because I don't think it was the case in the past years. Because if it had been the case, he would have mentioned it to me. And it was not the case. So just want to mention to the chair, you have to be sometimes careful what staff will tell you. The city manager is the person the Auditor General deals with, and if there's issues, the city manager should address that. So,
Okay, that's all. I'll leave it there, Chair. Thank you.
All right, Vice Chair.
Thank you. I just want to follow up on this piece. Mr. Kirkpatrick, there's been mention that part of this problem is the idea that we're calling them vacant positions. Are we exploring different ways to categorize these positions?
Yes, we're looking at applying different terminology, as the Auditor General indicated. This is primarily, recommendation number 2 is primarily an issue of seasonal positions used in Parks and Recreation. We felt that the motion that Council had passed directing that the reporting of positions that had been vacant for more than 24 months, which specifically excluded the use excluded the reporting of those kinds of positions. The Auditor General's point was, well, if there are those kinds of positions that have truly been vacant for 24 months, those should be reported. Mm-hmm. Our position at the time was the motion exempted them. We don't want to have to do the work of figuring out whether they've actually been vacant or not. We had a discussion where we arrived on, okay, what is the goal? What the Auditor General's goal was positions that have truly been vacant, so i.e. they have not been used in any way for casual or pooled or temporary positions in those casual or those seasonal programs. They should be reported, and we agreed, yes, they should. So, again, I think it represents perhaps an example, coming back to Councillor Drosh, indicated if we had spent more time attempting to reach a greater clarity of what the core of what the Auditor General felt was important to be achieved, we may have found that resolution earlier.
Okay. Thank you.
Okay. Are there others? Councillor Egley?
Actually, as much as I'd like to prolong the meeting, the vice chair covered off the topic I wanted to talk about, so I'm good.
All right, is the item received then? Okay, it's received. There are no in-camera items. Notices of motion for subsequent meetings? None. Inquiries? Other business? Adjournment? Okay, it's carried. Carried, we're adjourned.